Exponent Philanthropy, formerly the Association of Small Foundations. Exponent Philanthropy is a vibrant membership organization that provides resources and valuable connections to help thousands of philanthropists with few or no staff make the most of the minutes they have and the dollars they give. We amplify and celebrate the work of this diverse group of givers who choose to give big while staying small. So today's webinar, as you all know, investments can be confusing, overwhelming, or downright scary for those without finance or investment backgrounds. And even if you have that in your background, managing a foundation portfolio calls for some different knowledge and skills sometimes. So today, we'll review basic investment terminology and what to look for and think about as you manage the portfolio. So we are joined today by John Church from Glenmede. John is a Senior Portfolio Manager for Endowments and Foundations in Glenmede's Philadelphia office. He provides investment advice and portfolio management for foundations, endowments, and other nonprofit organizations. And I'm Lauren Kotkin, Senior Program Director, Exponent Philanthropy, your webinar organizer, and I'm joined here in our Washington, D.C. office by my colleague, Nikki Hilgert, who's Program Associate here at Exponent Philanthropy. She'll be helping out with your questions today. We are recording this webinar, and it will be made available to members after the program. And now a quick review of the GoToWebinar technology. So there, we know we have some newbies out there. Thanks for joining us today on your first webinar. We want to make sure you understand how it works. We've got two parts to your screen. You'll see this viewer window where you see the slides. The viewer window can be resized by clicking and dragging the lower right-hand corner, or where the blue arrow is pointing, there's a little zoom button. And if you click on that zoom button, you can make the slides appear larger or smaller in your screen. There's also this control panel, and you'll see the first, that orange arrow. If you click that, it's called the Grab tab. It will minimize, it'll make your control panel smaller so you can see the slides in full. And if you click it, the arrow in the other direction, it opens it up so you can ask a question, which is what you type in here. When you type in a question into that box, it comes to Nikki and me in our office, and we'll be able to respond to your questions. And just a reminder that for those of you on Twitter, please use our handle @ExponentPhil or use Glenmede's handle @Glenmede if you tweet about the program, and we hope you Twitterers out there do so. And my last housekeeping is to thank our Platinum Sustaining Partner, Glenmede, for partnering with us on today's program. We appreciate John sharing his knowledge and answering your questions, as well as Glenmede's support of Exponent Philanthropy and our educational programming as a Platinum Sustaining Partner. So thank you very much. And now I'm going to be passing it off to John, who will review the agenda. John has also asked that I interrupt him if there are any clarifying questions. So if he covers something and you're not quite sure what it is, put a question in your questions pane, and we will get back to, I'll interrupt him, or we'll get back to you at a regular interval. So with that, I'm passing off the reins. You'll see a brief change in your screen as I pass the reins to John, who will then open up his computer. We're now seeing his computer instead of mine. This is the great awesomeness of technology. And as soon as he's ready to go, he will say hello. So John, when you're ready, just let us know, and passing it off to you.
Thanks, Lauren. And hello, everyone. Thanks so much for joining us today. We really appreciate your time. And just to give you some background, today's webinar will focus on investment terminology, sort of an investments 101 session, really to broaden your general, there we are. To broaden your general knowledge of investments, and also to help you apply that knowledge as you review and discuss your foundation's investment reports with your colleagues. So just to start off, early in my investing career, I had a great mentor who taught me that investments can be very straightforward, but there are a lot of buzzwords out there that can muddy the waters. And she said that even if you know a handful of these buzzwords, it can go a long way in your understanding of investments. So that's something that's very important to keep in mind. Investing is really very simple, and the more experience that you have with it and the more that you do collaborate and get together with your colleagues and look at your investment reports, the easier this will all become over time and the more familiar to you. So let's start today with the definitions and mechanics of two very prevalent investments, stocks and bonds. So what are stocks? Well, simply put, they are shares of ownership in a company. So if you own 20 shares of Apple stock, that means you own 20 shares of Apple Corporation. Now, keep in mind, there are 6 billion outstanding shares of Apple stock. So your 20 shares are just a very small portion of the company. Stocks are also called equities because by owning a stock, you are an equity shareholder in the company. Now, investments in stocks tend to be risky. The stock price on Apple could double from $100 to $200, meaning your investment in Apple stock would double. But that investment could also go to $0 if the company went out of business. Now, that's not likely to happen, but it is something that could happen. So again, stocks are very risky. So let's take a look at some of the terms used to classify stocks. You might see some of these terms as you review some of your foundation's investment reports. First off, stocks are often classified in terms of size based upon market capitalization. Market capitalization is defined as the price of a stock multiplied by the total number of shares outstanding. So a large capitalization or large cap stock would be something like Coca-Cola. Coca-Cola is valued at over $100 billion in market cap. Whereas a small capitalization stock, such as JetBlue Airways, which is a regional airline, might have a market cap of less than $5 billion. So typically small cap stocks are the smaller ones, the larger cap stocks are the larger ones, just as their names would imply. A second way that stocks can be classified is based upon style, so value or growth. Let me explain what that means. Value stocks tend to be cheap stocks that might be trading at a lower price than what some investors think the stocks are actually worth. So an investor would want to buy a cheap stock if they think that it's a bargain. So this is Warren Buffett's investment strategy. He's a classic value investor. Johnson & Johnson is a very good example of a value stock. On the other side of the coin, there are growth stocks which tend to have earnings growth at a faster rate than the overall market. So an investor would want to own a growth stock because they think that the company might be innovative or make a lot of money. Google is a good example of a growth stock like this. Lastly, we have geography. There are domestic or U.S.-based companies, so that would be something like Comcast here in Philadelphia, or internationally based companies such as Baidu. Baidu is China's version of Google, essentially. So for example, if you were to classify Apple, Apple would be a U.S.-based large cap growth stock. Okay. Now, Lauren, I think it's time for our first poll for the participants.
Great. I'm going to launch the poll. Let's see who can get this. Let's see which of the following companies would be classified as a U.S. large cap stock. Put in your votes. We don't know who you are, so take your best guess, and we'll see how everyone did on our first pop quiz. Okay, we've got most of the people voting. We'll give you another second, and then I'm going to close the poll. Any last votes? All right, I'm closing the poll, and I'm going to share the results. And John, what is the answer and why?
Actually having a little bit of trouble seeing the results right now.
Okay, so it's, I'll tell you what it is.
All right.
35% of the people said Nestle, 55% said Disney, and 10% said Toyota.
Aha. Okay, very good. Well, this was sort of a trick question. So it was the correct answer is actually Disney. Nestle, believe it or not, is a Swiss-based company. So when we talk about what is a U.S.-based stock, Nestle is actually based in Switzerland, and Toyota actually is based in Japan. Disney is the true U.S. company. Now, it's interesting to think about that all of these companies have very global revenue streams. So they're making money all across the world. Toyota sells its cars all over the world. Nestle certainly sells chocolate here in Philadelphia. In fact, we have some in our room here right now. And then Disney, even has the Disney World that's over in France. So, they're all very global companies. But when you think about calling something a U.S.-based company, it's really based upon where their headquarters are. And of those three companies, Disney is based in the U.S. Okay, so let's continue on now, and let's take a look at how we would make money on stocks. There are really two ways to make money on stocks. The first is, obviously, if the stock price goes up and then you sell your stock, you can make money on it that way. The other one that's a little bit more complex is to make money if the stock pays a dividend. Now, a dividend occurs when a company decides to pay out some of its earnings to shareholders rather than reinvesting those earnings back into their business. Not all companies pay dividends, though. For example, many small-cap companies do not pay dividends because they actually need to reinvest all of those earnings that they make back into growing their business. So that's stocks, and it's pretty straightforward. There are a couple of ways to make money out there. Just keep in mind that they're a little bit more risky than some of the other investments we'll talk about today. Now let's take a look at bonds. Bonds are very different, and simply put, bonds are investments in debt. So for example, if someone buys a house, they might obtain a 30-year mortgage with a fixed interest rate to finance the purchase of that house. Now, as an investor, your foundation might in turn buy that mortgage, owning the debt, and then collecting the homeowner's fixed interest payments over time. This is why owning debt is referred to as fixed income. Bonds, debt, and fixed income, they're all synonymous terms. Generally speaking, investing in bonds is less risky than investing in stocks. And we'll come back to that last point shortly, but bonds tend to be much more stable as compared to stocks. So now let's look at how bonds are classified. Bonds, first off, are classified by sector. The way to think about this is who is issuing the bond, so who's taking on the debt. For example, the U.S. Treasury bonds are issued by the U.S. government. Corporate bonds are issued by corporations. So for example, IBM might issue a bond that's based upon the merits of its corporation. Another bond classification, very similar to stocks, is geography. You may have heard the term sovereign bonds. This actually refers to international government bonds. So for example, a Japanese sovereign bond is simply put a Japanese government-issued bond. Another very important bond classification is by the credit quality of the bond borrower. Specifically, what is the likelihood that the borrower will pay back its debt to investors? So for example, that bond issued by IBM is considered to be high credit quality. This is known as investment grade credit because IBM is very likely to make its interest payments on the bond and to pay off its debt over time. Now on the other side, a bond issued by Sears, which is a department store chain, sort of a dwindling department store chain, is considered low credit quality, and this is known as high yield because Sears is really struggling and actually runs the risk of going out of business. And I should say going out of business again because they've already done it once. Okay, so how do you make money on bonds? There are two ways. The most common way to make money on bonds, and this is where most of your money comes from, is receiving interest payments. Because remember, as an investor, when you buy a bond, you're loaning money and you're receiving interest payments in return. Interest payments are also called coupons or yield. In the old world, bond investors actually used to go out and you would clip coupons out of a book, and that would be your merit, your ticket really to collect your interest payment over time. So coupons are sort of an old term that have hung around. The other way is that bond prices can change over time, and that's another way to make money on bonds. One of the interesting characteristics of bonds is that they do have a finite life, which is known as a maturity date, and that's simply put the date when investors will have their loan repaid back to them. So to look at an example of a bond, let's say as an investor you decide to spend $100,000 for a 10-year Treasury bond that matures on January 1st of 2020, and it's paying a 3% annual interest rate. So what are your profits on this bond? Well, let's think about this. The bond was issued back on January 1st of 2010 because it has that 10-year maturity, and that 10-year life means it will mature on January 1st of 2020. You're receiving 3% or $3,000, so that's 3% of 100,000 per year for 10 years. So 10 payments of $3,000 means you're collecting $30,000 of total interest over the life of this bond. On January 1st of 2020, the U.S. government then repays your $100,000 loan. So your total profit is $100,000 for the loan balance and $30,000 in interest payments. So you get $130,000 total. Now keep in mind that it took you the full 10 years in order to make that $30,000, so this isn't exactly an exciting investment. Okay. So in that example, the bond's interest rate was 3%. Let's talk about how a bond's interest rate is determined. First off, it's based upon the maturity date. Is it short or is it long? In other words, is this a one-year bond, which would be a short-term bond, or is it a 30-year bond, which is a longer-term bond? Longer maturity generally equals a higher interest rate. Second off, it's based upon the credit quality of the borrower. A lower credit quality is going to give you a higher interest rate because you really have to incentivize the investor because you're actually buying something from a low-quality investor out there or a low-quality borrower. You need a higher interest rate in order to compensate that investor for taking the risk. So those two items, the maturity and the credit quality, are shown in this chart over on the right-hand side of the screen. Geography is also something that plays into determining interest rates. Generally speaking, international bonds do have higher interest rates than the U.S. So the last point that I'll discuss on bonds is how a bond price moves. Bond prices are affected by changes in interest rates over time. If interest rates rise, bond prices fall, and the opposite is true too. If interest rates fall, then bond prices will rise. This is an inverse relationship. To illustrate this concept, let's suppose that my foundation invests in a 3% IBM bond. So that's an IBM bond with a 3% interest rate. This is a fixed rate bond, so that 3% won't change over the life of the bond. Now in the market, all of a sudden interest rates have risen, and I could now go out and buy a 4% IBM bond. So if I wanted to sell my 3% bond, I'd have to do so at a lower price because it's only paying 3%. So my bond price has gone down as the interest rates have gone up. Okay, so Lauren, I think it's time for our next poll.
Great. I'm going to launch the poll, and we had a question while you were talking about bonds, so I'm going to put the question out there while I launch the poll,
okay.
Which is, can you explain senior debt and subordinated debt in an impact investment? And is that something we should table to the end? Does it relate to bonds?
Oh, it absolutely relates to bonds. We can talk about that. Senior debt is essentially, senior and subordinated debt is really a hierarchy. So investors that would hold senior debt would have a preference to get paid first over subordinated debt. In other words, if the bond defaults, and that default means if Sears does not go out and actually pay off their debt at the end of the life of the bond, what that means is that all of a sudden all the investors now have to get in line for who's going to get paid back. The senior debt holders would get paid first, and if anything's left over, then the subordinated debt, which is essentially the junior debt, would get paid next. So it's really just a hierarchy of the two. That's a great question.
Thank you. We have the poll open now. Which bond might have a higher interest rate? So you've got your 5-year U.S. Treasury, 10-year German government bond, 10-year Greek government bond. We have about half the people have voted, because I'm sure some people were listening to your response about debt. So if anyone else wants to vote, we're up to 80% of people have voted. I'll give everyone a couple more seconds to put in there. And remember, I will not know who voted for what. Little pop quiz. So I'm going to close it, and almost everyone has voted. So I'm now going to close and share. And John, I'll let you know we had 15% who said the 5-year Treasury might have a higher interest rate. 15% said a 10-year German bond, and then 69% said the Greek government bond would have a higher interest rate. What is the correct answer and why?
The correct answer is C, the Greek government bond. So again, this is a little bit of a trick question in here, but the first clue that would tell you that it's a higher interest rate is that it's a longer-term bond. So a 10-year rather than a 5-year bond is going to have a higher interest rate. And the reason for that is that, think about it, it's sort of an opportunity cost. So you hold a bond for 10 years, and that's money that you're not able to go out and spend in other places. So you're kind of stuck with whatever that interest rate is. So a longer-term bond has to have a higher interest rate in order to incentivize those investors to buy that longer-term bond. Now, the second part of this question really was the kind of the trick part, which is to say, which is a more stable economy right now? Is it Greece or Germany? And Germany is much more stable. So Greece is the one that's going to have a higher interest rate, again, because the credit quality of Greece is much lower than it is for Germany. So the answer is C. Okay, so outside of stocks and bonds, there is also a group of alternative asset classes. And we'll talk about those a little bit now. Some of these alternative asset classes include commodities. So these would involve buying gold, coffee, or natural gas. Oftentimes, transactions in commodities are made through contracts. So the investor's not actually holding the gold or the natural gas. They're just holding a piece of paper that says that they hold some kind of a commodity contract. Otherwise, things can get kind of messy, especially when you start dealing with things like livestock. So the next one would be real estate. For example, if you rent your home, you can collect rental income from your tenants. So real estate gives you a way to get some additional income on your investments, and of course, real estate prices also change over time. A third alternative asset class is private equity. In private equity, you invest in companies that are not available in the public markets. For example, venture capital is a strategy whereby you give money to private startup companies. Buyout is a strategy where you take a company private and then try to restructure it and sell it for more of a profit. The key concept behind private equity is that it is illiquid. What that means is that unlike owning an IBM stock where you could go out and buy it and sell it today on the market, on the New York Stock Exchange, you cannot easily sell private equity because private companies just don't trade on an exchange. They don't have any active market for them in the trading environment. So that's an important consideration of private equity, is that they're illiquid for investors. The last one is hedge funds. Hedge funds are very flexible strategies that have the ability to make money whether markets are going up or down. And this is because they can bet against the market. This is why the term hedging is used, because essentially hedge funds are hedging their bets in their portfolios and really hedging your bets in the overall portfolio for the foundation. So now that we've looked at the asset classes, let's take a look at how you would package your investments together. And most investors do not just buy a few stocks or bonds. Rather, what they do is they invest in more diversified investment vehicles such as mutual funds. So in a mutual fund, all investors hold the same proportion of the underlying investments. Let's say, for example, in a mutual fund that has two stocks, one investor might invest $1,000, and they're going to have 50% invested in Comcast and 50% invested in General Electric. Now, another investor might come along and invest $2,000, and that investor also gets 50% of Comcast and 50% of General Electric. So while in that example we only had two stocks, most mutual funds tend to have more like 20, 30, even 50 or 1,000 stocks in some cases. So they're very diversified investment vehicles with the investments spread out across a lot of different companies. Mutual funds can be actively managed, whereby a portfolio manager tries to outperform the market, or they can be passively managed, whereby a portfolio manager is trying to actually go out and mirror the market.
John?
Yes, Lauren.
We had someone ask about REITs, which I don't know how to pronounce. So if is that a good place to enter that question here? Is that
sure? Actually, so those are REITs. REITs are called REITs. They're real estate investment trusts. What's the question specifically?
What are they?
Oh, okay. So I would have to actually go back here for a second, and we'll talk about this on the real estate slide. REITs are actually would fall under the real estate bucket. Real estate investment trusts are essentially, think of them as sort of holding corporations that own things like office properties or hotel chains or shopping centers. And the idea is that they collect rental income and then pass through that income to investors. So they're very popular vehicles because investors can actually make a lot of interest on them. They're very popular right now because interest rates are currently very low. So if I went out and bought bonds, the interest rates on my bonds would be very low. REITs, on the other hand, might pay a little bit more because they're actually taking all of that interest, that income that they're getting from the rental properties, from the tenants, and then passing that through to investors. So REITs are really just a subset of the real estate category.
Thanks.
Another good question. Okay, so let's look at some other examples of investment vehicles. These can include things like exchange-traded funds, also called ETFs. These are very similar to mutual funds. The difference being is that they're priced throughout the day, whereas mutual funds are only priced once per day. So ETFs tend to act more like stocks in that regard. Then there are separately managed accounts, which are often run by a mutual fund portfolio manager, but the difference is that they can be customized. So for example, if an investor wanted to exclude tobacco stocks from their investments, they could invest in a separately managed account, instruct the portfolio manager to exclude tobacco stocks, and they would have their customized portfolio. Another example is partnerships. Partnerships are more complex structures typically used by hedge funds or private equity funds. They're not usually regulated, and because of that, it allows for the use of much more flexible investment strategies. So there are a lot of different ways to package investments, but mutual funds, exchange-traded funds, separately managed accounts, and partnerships are some of the things that you might see on your foundation's investment reports. Okay, so Lauren, it's time for our next poll.
Great. So I'm going to launch the poll. So we have this little pop quiz, and we don't know who is responding, so just take a guess. Which of these is not an alternative asset class? And the choices are hedge funds, partnerships, private equity, real estate. Not an alternative asset class. And then John will look at our responses, tell us what is correct and why. So polling is in progress. We have pretty much everyone has voted. So I'm going to close the poll and share the results. And John, we have 4% said hedge funds, 48% said partnerships, 26% said private equity, and 22% said real estate. So what is the correct answer and why?
Interesting. Okay, so partnerships is the correct answer. Partnerships are an investment vehicle, so that's a way to package maybe hedge fund or private equity investments. But the alternative asset classes are commodities, real estate, hedge funds, and private equity. So think of partnerships really as just a method to go out and invest in alternative investments, but partnerships are not actually an alternative investment in of themselves.
And John, just one more question. Why do they use the term alternative, since they seem to be pretty common that people use hedge funds, real estate, commodities in their portfolios?
Yeah, that's a great question. I think the alternative investment moniker will probably start to go by the wayside pretty soon. They are very common now. I think that when most investors, even 10 years ago, really did not have much more than stocks and bonds in a typical portfolio, so this was sort of a classification that brought everything together. There are very specific merits of each of these different asset classes, and the most important thing, no matter what you're investing in, is really to try and understand what it is that you're trying to do in your overall portfolio and why they actually play a role in that portfolio. Which actually, Lauren, is a good transition to talking a little bit about the next topic, which is return, risk, and diversification, which we're going to cover now. So every foundation wants to make money on its portfolio, and different asset classes do have different amounts of potential return and potential risk associated with them. So what I mean by that is return measures the percentage increase or decrease in an asset class's value over time. So for example, your fixed income might have a positive 10% return in 1 year, which means it went up by 10%, or it could have a negative 10% return in a year, which means it went down by 10%. And there are different amounts of return for the different asset classes as time goes on. On the other hand, you have to measure risk, which measures the degree of market value fluctuation over time. So in other words, the degree of ups and downs in the asset class value over time. What this chart is doing here on this page is to show you that lower risk investments, such as cash and fixed income, tend to generate lower investment returns over time because they also have that lower risk. But higher risk investments, such as private equity or small cap equity, may generate a higher return over time. And the real key to understand here is that the more risk an investor takes, the higher the return must be to compensate that investor for having taken the risk. So remember that we talked about private equity before. It's an illiquid asset class. You really can't go out and sell your investment. That means that the investor really has to expect that they're going to get a very nice investment return on that investment in order to be compensated for that illiquidity, because they can't take that money and use it anywhere else. It's locked up in that private equity investment. So that's kind of why it's the highest return, but also the highest risk type of an investment. So now let's look at diversification. One of the most important concepts in investing is diversification. This is the concept of investing across a range of asset classes and strategies. In other words, not putting all of your eggs in one basket. So why is this important? If one asset class performs poorly, well then another asset class will probably perform better. And it's important to diversify portfolios in several ways. The first is by asset class. So you want to invest in not only stocks, but also bonds, and if it's appropriate, hedge funds, commodities, and those other alternative investments. You also want to invest or diversify by investment style, value and growth stocks, for example, and even by investment manager or underlying strategy. So it's a very important concept, because what diversification does, as we'll show on the next chart, is that it helps to limit your total risk over time. So this chart is something that we commonly refer to as the quilt chart here at Glenmede. And to illustrate the importance of diversification, what we're doing here is to show you different asset class returns over 5-year periods going back over the past 20 years. And the first thing we've highlighted on this page at the upper left is from the period of 1994 to 1998, U.S. large cap stocks returned 24.1% per year over that 5-year period. So that was a very, very strong return. Now, you go to the next column and look all the way at the bottom. 1999 to 2003, U.S. large cap stocks returned negative 0.6% per year over this 5-year period. So they actually turned out to be the worst performing asset class over the next 5 years. The point to this page is that there's a randomness to the chart. It is much better to invest in a basket of these asset classes, because over time it can help the overall portfolio achieve a higher return without taking too much risk. So that's why it's very important to spread out your portfolio and not put all of your eggs in one basket. So to this point, we've covered asset classes, and we've talked about diversification, risk, and return. Now let's take a look at investment policy statements and
John,
a little bit about why they're important. Yes, Lauren.
Before you go, can you go back to that slide? Someone wanted to just understand annualized return.
Sure. Annualized return means if you take a period greater than 1 year, annualizing the return, it's not a straight average, but it sort of averages out the return over multiple years. So for example, if you look at the 20-year column over here, and we look at private equity, over the last 20 years, private equity has returned an annualized 14.7%. That means that it's returned 14.7% per year on average over the last 20 years. It's different from a cumulative return. A cumulative return would actually take 14.7 plus 14.7 plus 14.7, do that 20 times, and I think you'd get a number somewhere like 290-something%, whatever it is. That's the cumulative return over the 20 years. But you want to look at annualized numbers, because that's a better way to compare different asset classes over longer periods of time.
And I have just one more about returns, which is what is the typical annualized return or range that one should expect to see in a small to medium-sized private foundation?
That is a great question. So I'll talk a little bit about what should be expected within a private foundation. Private foundations, by IRS rule, have to pay out 5% on an annualized basis. And then the other important consideration is to make sure that you keep up with inflation, because as you're putting out your grants to beneficiaries every year, you need to make sure that you're accounting for their rising costs. So inflation is another concern. Assuming that inflation is about 2.5% per year and you have that 5% payout, you need to get to about a 7.5% return in your portfolio in order to maintain the value of the foundation over time, net of those grant payouts and that inflation over time. So we try to, when we're constructing portfolios, give investors a little bit of a buffer and try to shoot for something that's a little bit above that. If you look at a typical portfolio, it will tend to be more invested in equities and a little bit less invested in fixed income, because equities really are the types of vehicles that are going to get you that, say, 7.5% to 8% return per year, as opposed to fixed income. But we do diversify across the different asset classes. So you can see on this page here, this diversified mix, we have 8.2%. If you were to take a diversified mix of all of these different asset classes over the last 20 years, that's actually what you would have gotten. And in our minds, that's a pretty sufficient return for a foundation.
Thanks. We're good on the questions for now.
Okay, great. Good questions. Okay, so let's talk a little bit about investment policy statements. Every foundation should have an investment policy statement. This contains the guidelines for managing a foundation's investment portfolio over the long term. If you haven't read your foundation's investment policy statement, I would encourage you to do so. Every single investment policy statement is unique and is customized to each foundation's unique characteristics. It could really help you to learn more about your foundation, and also encourage you to ask some good questions to other committee members, trustees, board members, staff members about why the investment policy statement was created the way that it was. So why is an investment policy statement so critical? First off, it aligns your foundation's investment plan with its goals. It's also helping to fulfill a trustee's fiduciary responsibilities. It removes the emotions out of short-term investing because it contains a long-term plan. It's very easy for trustees, for staff members to look at a portfolio, particularly after a very, very tough period in the markets, and want to make a change. The investment policy statement keeps the long-term focus and keeps the plan in place. And it provides continuity as trustees, board members, and staff change over time, so that as new people come in, they can understand why the portfolio is structured the way it is and ensure that there's a cohesive and consistent approach being used. So a good investment policy statement should contain the foundation's mission statement, goals, and objectives, but it should also outline the time horizon so the portfolio can align with the expected life of the foundation. Typically, most foundations are expected to be around for a very, very long time, so it's usually important to have a very, very long time horizon on your investments. The investment return objective is also very important. This is where you want to meet that 5% payout plus inflation over time. So as we just talked about, that's about 7.5% to 8% per year. Any other special considerations should also be captured. For example, socially responsible investing preferences is something that a lot of foundations are now considering. Perhaps they are not investing in tobacco, or they might be avoiding fossil fuels. And then it contains a roadmap, which essentially is saying which asset classes are permissible for investing and how much may be invested into each asset class. So across equities, fixed income, cash, alternative investments, what we're showing here is this target allocation is essentially your neutral allocation, and then we assign a minimum amount and a maximum amount to each asset class. So in this investment policy statement, we would have a 60% neutral allocation to equities. We could not go below 50%, and we would not go above 70%. So that's your roadmap for the long term. There's a lot of flexibility here to adjust things based upon market conditions, but you're not straying too far away from what your long-term goals are. Okay, now to bring everything together that we've covered today, and I would encourage everyone to take a few minutes and, when it's appropriate, review your foundation's investment reports, or if possible, sit in on a portfolio review meeting. you can really learn a lot in these meetings, and I think you'll be able to apply a lot of the concepts that we've discussed today in those meetings. When you're thinking about the portfolio, you want to ask some questions such as, have changes been made to the portfolio over time? And why have those changes been made? Is the portfolio properly diversified? Does it make sense given the economic environment? Are there any changes that are being contemplated over time? And compare those results with previous reports and see if there's consistency and really just understand exactly why things are being done the way they are in the portfolio. Most important, when you look at a foundation's investment report, it must be reflective of that investment policy statement. So if I had a portfolio that was invested in 40% equities, let's say, and we were looking at that last example here of the investment policy statement, I would actually be out of bounds of the investment policy statement. I would be at 40 here, which is not within the permissible range. If you have an investment manager that you're using, the investment manager really should be bringing that portfolio back in line. And if they're not, you should be asking them why they're not doing so. We've seen that example happen a lot with some groups that we've worked with. Not at Glenmede. We try very hard to keep things in bounds. But it is something that happens and is a very, very important consideration.
John, here's a question backing up to what you should be reviewing. Somebody said that their reports come back from their investment managers that are hundreds of pages long. What sections or specific reports within the whole packet would you recommend reviewing? And my subsequent question would be, how can you ask your investment advisors to get you the information that you actually need if it's hundreds of pages long?
So I'll speak to that latter point first. I think calling the investment advisor or emailing them and asking them really there are three very important things. You should always be looking at a copy of the investment policy statement to understand what the parameters are. You should be looking at an asset allocation, which actually is something that we're going to look at here in just a moment, and you should be looking at investment performance. Holdings would also be a consideration, so understanding what are the actual underlying investments in the portfolio, how are they broken across different, let's say, mutual funds or hedge funds or whatever might be in the portfolio. And then lastly, maybe some economic slides as well that would give you a little bit of background on the economic environment. But I think the investment policy statement, the asset allocation, and performance are really the three most important things. And you know, it's really just as simple as emailing or calling the investment manager and asking them to customize the package. That's something that we do for a lot of our clients, and some clients do want to see that full 100 pages or whatever it is that they receive because they really like the detail.
Did you notice my bias in that question then? I have one more that just came in before we move on to asset allocation, actually. It's a good dovetail. Okay. But speaking of cash is the first thing on that list. If you receive a large amount of cash, how long should it take to bring it into compliance with the IPS? So maybe you could talk about why someone would receive a large amount of cash and then bring it into those minimum and maximum.
Good question. So there are a lot of ways to answer this. It's really based upon preferences, not only by the foundation, but also by the investment manager. It's also based upon the market environment that we're in. I can think of examples where we have received cash and a foundation has said, we would like to invest this you know, over time, but please do so as you see fit. There are other instances where a foundation might ask us to invest it all right away. Generally speaking, if we get cash with no instructions, which is what it sounds like has happened here, we try to put that cash to work right away. Generally, research has shown that putting cash to work sooner rather than later does tend to actually be a good investment strategy because markets do tend to go up over time. And more than half the time, markets are going up. It's very difficult to time the market. But in the same token, with equity markets right now trading very close to record levels, there's a case that can be made for spreading out the speed of deploying that cash over a couple of months and doing it in a few waves. So there are a lot of ways that you can do that. I would just encourage you to have a dialogue with your investment manager so that everyone's on the same page and that everyone's expectations are in line.
Great. No more questions.
Okay. So let's look at reviewing a foundation's asset allocation here. On this slide, This is a report that's showing our actual asset allocation. I'm going to pick on fixed income and equities. Has 23% invested in fixed income and then 40% invested in equities. Let's just focus on those two numbers for a moment. If we look at how our investment policy statement was structured, remember this is our neutral allocation. We only had 14% in fixed income, but we had 48% in equities. So what that's saying is that right now, the actual portfolio has a 9% overweight to fixed income, which means it has 9% more than normal invested in fixed income, but it also has an 8% underweight in equities overall. So what this tells me by looking at this report is that whoever's managing this portfolio is not feeling very good about the markets because they have less than they normally would in equities and they have more than they normally would in fixed income. So as you look at this report, if I was in an investment meeting, I would be asking questions like, okay, so why don't you like the equity markets right now? Do you think that this portfolio is still going to be able to generate the sufficient return for the foundation over time? And are you expecting to make any changes over time? And see what the investment manager says. You can drill into a little bit more detail on these pages here, looking at large cap, small cap, and international weights and some of the differences there, for example. But these are the types of things that are typically discussed when we're in investment committee meetings. So that is one of the very important reports that you should look at. The second one is really reviewing investment performance relative to benchmarks. Think of a benchmark as the market. Has your portfolio's performance beaten its benchmarks? In other words, has your portfolio beaten the market? So the table on this page is showing commonly used benchmarks for a range of different asset classes. Normally, when we would look at an investment report, we would want to say, how is our large cap equity portion of our portfolio performing relative to the S&P 500 index, which is an index of U.S. large cap stocks. The same thing would go for something like fixed income. The Barclays Aggregate Index is a very broad fixed income benchmark, and so on. I haven't shown all of the asset classes here for simplicity, but there are a lot of different asset classes and different benchmarks out there. The important thing is that you have the ability, through the reports you're receiving, to measure the performance of the different asset classes relative to the respective benchmarks over time. And again, this is a very important point of discussion and something that you should spend a lot of time on with your investment advisor in your ongoing meetings. Okay, so Lauren, it's now time for our final poll.
Okay, I'm launching the final poll, and it's about the investment policy statement. Why is the investment policy statement important? Aligns investment plan with foundation's goals, helps fulfill fiduciary responsibilities, reduces emotionality, provides continuity, or E, all of the above. And people are voting. We've got 70% of our participants who voted. I'm going to give it another couple seconds. Anyone else? Final votes? Okay, I am closing the poll, and I'm sharing the results. John, it looks like 96% said all of the above, and we have probably maybe one vote on Align's investment plan with foundation goals. So if you could just share any comments on Align's investment plan and then versus all of the above.
Sure. Well, I would say that the person that voted Align's investment plan, that's probably the most important thing because that's all-encompassing and includes everything on the investment policy statement. But it is, the correct answer is all of the above. These are all very important considerations in the investment policy statement. And again, I would really encourage everyone to go back and look at your foundation's or organization's investment policy statement. It's a really critical document. And you might be surprised to find out that you don't have one. And if you don't have one, that's okay. But it is something that you should look at and should think about crafting, whether you're utilizing the resources of Exponent Philanthropy or of your investment advisor. That is something that you should look to establish over time because it does set the precedent for everything that goes on in the portfolio. So with that, I guess we'll take some questions.
Yeah, so what other questions do people have? You can type it into your questions box. I'll give folks a minute to type them in. I do have a couple that came in that we haven't gotten to, so let me start with those. And again, if you have a question, just type it into your questions box. This foundation says it's a mid-sized foundation with about half invested in one pharmaceutical company that the founder started. How is that? Is that diversified, or what do you recommend when someone has that kind of portfolio?
Yeah, that's something that we see a lot, actually. That's a great question. Those types of scenarios, I would not consider that to be a diversified portfolio, because think about it. If half of your portfolio is invested in one pharmaceutical stock, your fates in the portfolio are really dependent upon what actually happens in that stock. So whatever the company is, let's say if it has a bad quarter and or maybe one of its drugs is not doing well and they lose their patent, whatever it might be, the stock could go down 30, 40, 50%. Now your foundation is going to be worth that much less. So I would encourage in those types of scenarios to try to diversify away from that single stock. Spread out your portfolio around some other investments. You can still hold some of that company, but 50% is too much. I would say anything more than 10% is a lot. And I would also say that because foundations generally are not paying taxes, that is something that is not, there's really no penalty in doing that other than potentially going against some of the wishes of, let's say, one of the founders. But I would, again, encourage you to talk to your investment advisor about that. It can be a very sensitive issue, but I know that they would be happy to walk you through some of the steps therein.
And John, where can you find investment language? Have you heard of Investopedia? And where else can you look for good investment terminology?
Yeah, Investopedia is a good resource. General terminology, that's a great place to go in and type in words that you might not understand. I would actually encourage people who really want to learn more about investments to subscribe to the Wall Street Journal. As cliche as that might sound, if you read the journal even for a couple of weeks, you'll start to pick up on a lot of terms that have to do with companies reporting their results and what are the important things that come out when companies do report their results, those sorts of things. You'll learn about things like mergers and acquisitions, where companies will combine with another company. Somebody goes out and buys another company out there. So you'll pick up on a lot of things that you might not have otherwise thought of in doing that, and a lot of that will actually translate back into the terminology that's used in these investment meetings. So that's another good resource.
And John, can you explain unrelated income taxes?
Boy, I'll try. I might need a separate degree for that. And we have a whole dedicated tax team here at Glenmede that goes over these things. Essentially, what unrelated business income tax is their foundations, generally speaking, have to file a 990 PF, which is essentially its tax return. But in doing so, they have to be very careful that they don't include any UBIT. UBIT is the unrelated business income tax, where there can be some separate filings that have to occur, and the foundation may actually be found that they have to go out and pay some tax. UBIT tends to be generated from some of the more complex alternative investments, things like private equity or hedge funds, but usually there are actually some vehicles set up called offshore vehicles that would allow you to get around having to go out and incur this UBIT. So again, it's very specific to the investments that are out there, but I would encourage anyone who's had an issue with this or is concerned about it to talk to their investment advisor about it and see if their specific investments in the foundation's portfolio might have any exposure to UBIT. I do know that at Glenmede we have not had issues with this in some of the investments that we've done in the alternative investment space, but you do need to be careful to invest in sort of the right sleeve of some of these investments, or you can end up having to pay some of that tax.
And John, we have just a couple minutes left, and so it's fitting that my first slide had the alphabet soup, because I've got two acronym questions. So if you could go over these two terms, then we'll wrap it up. CIVs and BPFs. What are they?
CIVs and BTFs. Boy, I have to.
Peter.
PTFs. Wow, I have to admit that I have not heard of PTFs, and forgive me for that. I can certainly follow up with you or whomever that is to discuss that in a little more detail. And
it's actually, sorry, it's B as in boy, P as in Peter, S as in Sam. BPS.
Oh my, I'm sorry, BPS. Okay, I can answer BPS. BPS are basis points. One basis point is 1/100th of a percent. So if you think, normally what happens is things like fees or expenses or even investment returns can be quoted in basis points. So 100 basis points is 1%. That's the best way to think about that. And I'm sorry, and you said that the other one is
CIVs.
Okay, I just want to make sure I get the right acronym on that too. So it's
C as in cat, I as in something with an I, V as in Victor, I as in igloo.
Great. And again, I'm not as familiar with CIVs. I believe it actually has to deal with actually pricing out. It's a method of pricing out a particular company or stock, but again, that's something that I'll have to. It's a very specific calculation methodology that's probably a little bit more advanced than we could get into on this call today. What I would be happy to do is to send whomever who asked the question a little bit more information about it, and perhaps we could talk offline about some of the specifics therein, because I think we could probably go into some detail that would take us beyond the length of this call today.
Great. And so I'm gonna. We had do you want one last alphabet soup question, and then I can close us out?
Sure.
Okay. This one is MLP. M as in Mary. L as in Lauren. P as in Peter. MLP.
Okay, that one. So MLPs are master limited partnerships. Master limited partnerships are things like investing in pipeline transmission for natural gas. So in other words, we've heard of some of the shale plays up in areas actually not too far from Philadelphia here, northeastern Pennsylvania. You need a way to transport the natural gas that you're pulling out of the ground over to whoever is going to be using that natural gas. And MLPs actually are investments in the pipelines that are taking it from one place to another, and the returns that are measured in those MLPs are actually based upon how much volume gets passed through those pipelines over time. MLPs are sort of interesting because they can be, they do have some favorable tax treatments for individuals. That's not really as much of a concern for foundations. They've been very, very popular investment vehicles in the last couple of years because they've done very well. And so typically they would tend to fall somewhere within that commodities bucket that we talked about earlier.
Great. John, thank you for your willingness to dive into a lot of these different terms, starting with clarifying all sorts of things throughout the presentation. So I'm going to make myself the presenter, and I'm going to close us out here. So we have been answering final questions, and I want to thank John for really a terrific presentation and distilling some confusing information. Some of these acronyms, definitely things I've never heard of, so we know there's a lot to learn, but it was a great place to get us all started in a really understandable format. So thank you for doing that. On the screen, we have some links to our website. I'll send those out later this afternoon. John, of course, is a great resource, and so is Glenmede. So thank you to Glenmede, our Platinum Sustaining Partner, for working with us on today's program, and of course specifically to John for sharing. John, thank you for sharing your expertise. You certainly have a way of making these terms clear for those of us newer to the field. Thank you. Again, John can be reached offline. I'll send his information after the call, and we'll connect those of you who had questions that we didn't get to John for further clarification. We have some more programs coming up. I will highlight that one of John's colleagues is going to be doing one of our live Q&A chats on October 2nd. So that's next Thursday. Live Q&A chat is a new program we have. You go online and you ask questions and you watch it scrolling on your screen as different people ask questions. So we have that coming up, and also a live Q&A on November 13th. And of course, our national conference, you'll get to meet the Glenmede team there. And stop by their photo booth. If you're coming to the conference on Friday, they're doing a photo booth in the exhibit hall. And of course, a thank you to all of you. Thanks for joining us today for this past hour. We hope you learned something, enjoyed the program. You'll be asked to take a survey as you leave. We appreciate your feedback as it helps us improve our programs for the future. So thank you all for joining us. And John, thank you again. And with that, I conclude today's program.
Thanks, everyone.